Hello everyone and welcome to our webinar today. Today we're going to be going over secured and unsecured business financing programs that you can get right now. We're going to be diving into the difference really today of secured versus unsecured business financing. A lot of people hear this on a common basis. You might hear about unsecured programs or secured programs, but it doesn't give you a lot of details about what that really means. So today what we're going to do is we're going to dissect this. We're going to take a look at secured financing programs, how they work, and we're going to take a look at a lot of secured financing programs out there that you might qualify for right now but probably don't even know about. The truth is the majority of unsecured and secured programs that are available for businesses right now are just not available at banks. They're just not programs you're ever going to find at a bank. So as a result of that, you may never bump into these on your own. So today we're going to take a look. We're going to dissect secured versus unsecured business financing, and we're going to take a look at a substantial amount of programs, both with secured and unsecured programs that, again, you might qualify for right now. So before we jump in, let me first introduce myself. If you've never been to one of my webinars before, my name is Ty Crandall. I'm the Director of Business Services. Hold on for the next hour. Again, if you've never been on one of my webinars before, I can tell you what to expect. First of all, you're not going to be sold anything. I don't sell any type of thing at my webinar. I'll just briefly say that if you ever want to offer business credit or financing for customers or ever need it for yourself, right there's my phone number, right there's my email. Feel free to reach out to me. That's the only sales pitch I have for you today. The rest is just nothing but content, nothing but solid information that I believe can help you. And my goal is that you can always walk away from one of my webinars with at least one solid piece of information, but I hope that today you're going to learn a lot of good things. About me, I've spent about 16 years in the finance space. Owned a very large, successful credit company, sold that many years ago, and I'm really one of the leading authorities out there in the business credit space. I've got two of the best-selling published books on credit and business credit that are out there. You'll find me all over the place, videos, articles, blah, blah, blah. The bottom line is I know a thing or two about business credit. I personally overseen the business credit building for thousands and thousands of clients. I still oversee one of the biggest operations in the country for business credit building and financing. So I know a little bit about this. And today what I'm going to do is just break it open. I'm just going to share with you everything I know. I'm going to give you as many details as I could possibly give you relating to secured and unsecured financing. So enough about me. Let's go ahead and jump in. Let's start today by talking a little bit more about secured financing. Secured financing is financing that is obtained using some kind of collateral. That is what secured means. Secured means that the collateral that's being used is serving as security for the debt. That's why they call it secured. So that means if you go out and get a loan and it's secured by something, that's exactly what secured financing is. And some simple examples of that on the consumer side, which I think are on my next slide, have to do with something like a mortgage or a car loan. Those are secured kind of financing. So secured financing in the business space is where you go to get money from a lending source, and that lending source says, okay, I'll give you the money, but in case of default, I want some kind of security, so I'm going to need you to pledge some kind of collateral that could be used as security in case you default on the debt. So if the borrower then defaults on that loan, the lender can then take that collateral that's used as security. So when somebody has security, when somebody has collateral they could use as security, it's just less of a risk to the lender because the lender knows that if the person ever defaults on the money, that they've got something of value that was pledged as security that they can take back and then sell and then get part of their money back for that loss. So that's exactly what secured financing is all about. And it's also why secured financing is much easier to qualify for than unsecured financing because you're pledging some kind of collateral, some kind of security. So the lender has kind of a hook to hang their hat on, whereas if you ever default, they have something of value they could take back and sell to recuperate part of their actual losses. So if you look at the lender will typically sell the collateral at auction or have a professional in that area handle the sale. Now what this means is exactly what they'll do with the collateral. So a perfect example here is a home mortgage. Okay, let's say you default you have a foreclosure and the lender comes and takes back your personal home. I know this isn't a business example, I'm just giving you an example that most people on this webinar can relate to. So if they come in and they take your house and they foreclose on your home, the lender doesn't turn around and try to sell it themselves. What they do is they hand it to a realtor in that area, and then that agent is responsible for everything involved with listing and selling that home. So what will happen with secured financing is if they do have to take back the collateral, then what they'll do is usually sell it at auction or have somebody that's more versed at selling that kind of asset handle it for them, like equipment, for example. Okay, they might go to a source they have that handles heavy equipment to unload that equipment in case of default. So the lender's goal is to unload that security very quickly, which is why much collateral is given a fire sale value initially. So this is what I'm saying. The bottom line is, if you have a piece of equipment that's worth $100,000, well, the lender's not going to give you a value of $100,000 because they're not looking for the retail value of your collateral. What they're really looking for is what they can sell it for quickly. They don't want to keep your $100,000 piece of equipment. What they want to do is sell it, unload it quick, and get their money back, as much money back as they can get. So because of this, there's a few things you need to know. First of all, they're always going to give you what I call a fire sale value. This is what they can unload that collateral for very, very, very quickly. So never be insulted. When you go in and try to get business financing and you're using a piece of equipment or something that in your mind has high value because the retail value is high, just understand the lender's going to way undercut that value, sometimes by as much as 50% of what it's really worth, because they don't care about the retail value. What they care about is a value they could sell it for really, really quickly. Okay, so anything is going to be giving kind of a fire sale value when it comes to collateral that's actually used for financing. Now, secured financing examples on a consumer side include a car loan, a home mortgage, a signature loan. Very common examples you can relate to. So if you're still trying to kind of wrap your mind around secured versus unsecured financing, on the consumer world, a mortgage is a perfect example. The home itself is collateral for the debt. You get a loan, you use the home as collateral. If you default on the loan, the bank takes the home, and then they sell the home, and they get their money back, as much money as they can get back. Or car loan, perfect example. You get a loan on a car. Okay, you default. They come take back your car. They sell it at auction, and then they try to pay back as much money as they can from what you owed. A signature loan. A good friend of mine in the local area owns a small consumer finance company that's a great example of this. You go in, he'll give you $1,000, $2,000, $3,000 if you pledge collateral. Usually the collateral is a car title or some kind of jewelry. So the bottom line is these are secured financing. These are something being pledged as security for the actual financing, for the actual loan itself. So let's take a look at some secured financing collateral on the business side. Common examples. Account receivables. The most common example of collateral for the business space. If you look at everything that's pledged as collateral in the business financing world, account receivables account for over 60% of all pledged collateral. So this is by far the biggest kind of collateral-based financing in the business space is account receivable financing. Now, if you're watching this webinar and you're trying to write all this stuff down, don't do it. Don't worry about it. We're going to dive into each one of these ones I've listed here individually. Okay, like I said, we're going to break it open today. So I'm not going to just tell you about account receivable financing. I'm going to tell you how it works, all the ins and outs that you would need to know to see if it's applicable to you. So don't feel rushed to try to write all this down on the slide really quickly. Plus, I will also send you a webinar. If you're attending through the webinar, I'll always send you a playback of the webinar just so you have it so you can go back, take notes on anything that you might have missed. Now back to the topic at hand. Account receivables, by far the most common kind of collateral used in the business space. Equipment is another kind of collateral. Now, you can't bunch together a bunch of small pieces of equipment, but if you have a big piece of equipment worth a large amount of value, could definitely be used. Inventory. Somebody that's a factory that has inventory on the shelves or a retail store that has inventory on the shelves can be used as collateral. Purchase orders. Commercial real estate. An auto floor plan. So let's say you're a car dealership and you have a floor plan of cars. That floor plan itself could be used as collateral. Even insurance agents, even though most of them don't know this, can use their own book of business that they've accrued of renewable commissions as collateral for business financing. So a lot of these are the most common business financing we see from day to day that people are pledging and using as collateral. Most common personal collateral that you could use for business financing includes stocks, bonds, other securities, 401k, cash in hand, and residential real estate only for private investor money. So stocks and 401ks are big time collateral used for business financing. A lot of people don't know this. Okay, we dealt with a client that owned a bar. He retired, was a retired police officer, started a bar, and needed capital to get this bar up and going. Well, in our interview, we found out he had like $700,000 in a 401k, and what he didn't know, as most business owners don't know, is that he was able to use that 401k as collateral and then actually qualify for like a 2% interest line of credit using the 401k as collateral. Again, I'm going to dive into that kind of financing a little bit later, but very common. We do a lot of 401k financing deals on a monthly basis. The same with stocks, bonds, other securities. Now, if you have cash in hand in residential real estate, I have a big disclaimer here. You cannot use cash in hand in residential real estate for almost any kind of collateral for business financing except for private money. It's the only reason I even list those two things here is because a lot of private investors will allow you to use a free and clear property that you own or actual cash that you put into an escrow account as collateral. You're not going to find a specific loan product out there that just lends against cash in hand or lends against residential real estate in the business space, but I list those two because you can commonly use those with private investors as some form of collateral. So let's take a look a little bit more at private money. Private money is a kind of, and what I'm going to do here after I take a big drink of water is to go through some secured actual programs. I'm going to talk to you a little bit more specific about a lot of these programs I just mentioned. We're going to dissect these programs so that way you can see if they maybe are applicable to you, maybe to your customers. So one of the secured kind of finance programs out there in the business space is private money, private investor money. Now, with your typical private investor, you need 2 years of positive financials. You've got to show that your business is growing or staying even keel, not declining every year in revenues, those type of things. You have to have some kind of collateral. Now, I say 20%. That's not common for all private investors. Just some of our investors go off 20%, so I thought it was a good amount to list. The bottom line is, if you're getting private money, they're going to want about 20 to 50% of some kind of collateral that you're going to pledge. Okay, rates on private money range from 18% and up. You know, most of our private money deals that we see get done are about 8 to 11% interest. You can get them as high as 18% if you're looking for a private investor. And these are working capital credit lines. Not always. Okay, some of them are loans. Sometimes private investors will just give you a loan. Sometimes they give you an actual credit line you could use and pay down and reuse. And they're usually looking for, about average credit scores, which is about 650, 660 FICO scores, or what we might call average credit scores that would qualify for private money. Now, a big misconception here is that I'm talking about private money. That's why I talked about it, even though you can't see my fingers, I'm doing quotation marks around it, because this is not equity financing. A lot of people think private money is equity financing. Here's the difference. Equity financing is like what you see on Shark Tank, where somebody comes in and says, I'm going to give you 50% of my business in exchange for the $50,000 I need. You are exchanging a portion of equity of ownership in your company for the money you need. That's not how private money works. How private money works is kind of like SBA. They look at whatever aspects of your business, your financials, your growth, your credit. They make sure everything fits their standards, and they lend you money, again, with some kind of collateral usually required. They lend you money. They don't, in exchange for that money, take a portion of equity in your business. That's equity financing. So for equity financing, you don't really need collateral because they're taking a big chunk of ownership of your business. But for most private investor money out there, it fits this criteria. It's not for a startup business. It's for an established business with tax returns and a business owner that has average credit. What they're looking for is what we call proven concept. So keep that in mind. When private investors, yeah, they're going to require some kind of collateral, and they're looking to see that you've already proved concept and that the business model that you have is already working. Okay, another kind of collateral-based funding program is SBA. Okay, SBA, you need 2 to 3 years of positive financials to qualify. It's a completely full documentation loan. Okay, so that means you need P&L statements, and you need projected financials, and personal financials, and business financials, and . Our application for clients for SBA is 14 pages. And it's not our application, it's a combination of all of SBA's application and the checklist of what you need. Very difficult to qualify for. As a matter of fact, while I'm talking about that, although SBA might be the most common form of business financing that you're used to, that you've heard of, the reality is that only 1.1% of all commercial business financing transactions are SBA. That's the reality. So this is why I'm glad you're on this webinar. Because if you think that you need money and you're going to go to your bank and get SBA, it ain't happening. Statistically, 1.1% of all business financing is SBA. Okay, that means 98.9% of financing that's out there for businesses is not SBA. It's not the financing you're just going to walk into your bank and get because SBA is so tough to qualify for. But you've got to show positive sales growth with them, and you have to have 50% collateral. Now, I saw very good statistics the other day that I was looking at that actually came, I'm not sure, from one of the government agencies. I think it's the Department of Revenue. That SBA, over 70% of all SBA loans require collateral. And just so you know, don't be deceived by that statistic. The only ones that do not are what they call micro loans. They're small loans. SBA 7A and 504, which is SBA's 2 most common products, require collateral. So 100% of all big SBA loans have to have collateral. Okay, but 70% of them all overall do because they're smaller loans they have that don't require as much collateral. Rates on SBA 5 to 8%, 10 to 25-year loan terms, and good credits required. How good? Well, SBA will tell you 620. We see 780 credit scores get declined. As a matter of fact, the sources we use for SBA say it's not even worth submitting if the customer doesn't have a 780 credit score. So you've got to have pretty good credit, if not really good credit, to qualify for SBA, just so you know this. It's probably not going to be the source you're primarily going to find that will lend you money, which is why statistically so few of business financing deals are actually SBA. But the one thing to know about SBA, just like private money, you have to have collateral. Okay, you've got to have collateral. It's at least usually 50% of what you're borrowing. So if you're borrowing $250,000, which the average SBA loan I think is about $260,000 per the Department of Revenue. So if you're doing that, you need about $130,000 in collateral that you could pledge to qualify for an SBA loan, which is why I put it on here as an actual secured loan. Okay, account receivable financing. So this is how this works. Up to 80% of receivables can be advanced within 24 hours. What am I talking about? This is what I'm talking about. The best example of this is a doctor's office, although it's applicable for a lot of different industries. A doctor's office, you go into a doctor, you see them, and you have health insurance or Medicare and Medicaid. They see you, the doctor sees you, they treat you, and then what they do is they turn around and they solicit Medicare, Medicaid, or the health insurance to get paid. Okay, so then they go to Humana, which is your health insurance company, and they have to get paid for Humana for your visit. Well, the problem is it could take Humana months and months to pay them, right? Think about it. Medicare, Medicaid, it's the government. It's not going to be quick. Okay, I was in the military. I understand the definition of hurry up and wait. The government's not fast. So these doctor's offices have to wait to get paid even though they've seen the patient. And this continues. For months and months, that doctor's office sees patients and doesn't collect the money that they're owed because they have to solicit Medicare, Medicaid, and health insurance companies to get their money. Well, what account receivable financing does is quite brilliant. What they'll do is they'll go to that doctor's office and go, look, don't wait anymore. What we're going to do is, since Medicare owes you $100,000, or let's just make it simple. On this patient, Medicare owes you $100. What we're going to do is give you $80 of that tomorrow. You don't have to wait 3 months. We're going to give you $80 tomorrow. Then we're going to go to Medicare. We're going to collect on the money, and when we get paid on that money, we're going to give you the other 20% minus our fee. That's how account receivable financing works. Now, the most common industries is construction, not builders. People that work for builders. Let's say you're a plumber. Well, if you're a plumber doing business for a builder, that's a good gig, but the problem is you might not get paid for months. So it works very good for the construction industry, very good for the medical industry, and very good for what they call general account receivable financing, which is just for a general industry. Now, you've got to keep in mind, these are for business to business only. Okay, it's not business to consumer. So a good example is if you cut lawns for a living, you can't get account receivable financing because all the people that you cut lawns for owe you money, unless those people that you cut lawns for are big companies. Let's say your job is you cut lawns for big companies, and those big companies don't pay you for 2 months. Then you could do account receivable financing. But let's say you're a normal lawn guy that just goes and does residential homes. You could not do it because your customers are consumers, not businesses. So account receivable financing only works business to business, but it's great for factories and any industry that has other people that owe them money, especially if the other people are government contracts. You get a contract with the state, the federal government, they owe you money. Great example of account receivable financing. It's not a loan. So what's actually happening with this is you're taking your future receivables and you're selling them at a discounted rate to the lender. So there's not actually a loan ever issued, which makes them quite easy to qualify for. Usually you can get $5,000 to $20 million loan amounts, 1.25 to 3% discount. What's this mean? Well, a discount's what they actually charge. It's not an interest rate because it's not a loan, but it kind of works the same. It's what they're charging you. And it's cheap, real cheap, real cheap. Okay, it's not even credit score driven, and you can get money at 1-2%, very common. So let's say you are that doctor's office. Now you can get advanced that money in 24 hours, have somebody else collect on the debt for you, really nice, and all you're paying is 1-2% a month on that money. It works out really well and very cheap to get. 4% fee, a lot of them will charge you right in the very beginning, a one-time fee to qualify. Qualifications. Receivables must come from another business or government agency. Business must be open for at least 1 year to qualify. Now here's what's awesome about account receivable financing. They don't give 2 cares about your personal credit. I mean, 350 credit score, like 2,000 tax liens, bankruptcy, your credit could be destroyed and you could still get account receivable financing because they're collecting on the money from Medicare, Medicaid, health insurance, for example. They don't care about your credit. They care about the credit of the people that they're collecting the money on, the people that your receivables are with. So they'll pull a business credit file on that company and make sure the company's legit and reputable and, pays their bills, but they don't care about you. So you can get approved for this financing even if your credit is trashed. I mean, severely trashed, you can still qualify for account receivable financing. Another common kind of financing for businesses, and again, I almost kind of list these in order of what we see. These are the order of popularity that we see people come in of what they're pledging as collateral using for secured financing. So 401k or IRAs can be used. This is a line of credit. It's not a loan. Okay, so they take your actual 401k value and issue you a line of credit. And you can get up to 100% financing based on what's in your 401k. The amount that you actually get, because I say up to, well, Ty, what determines the up to? Well, the up to is determined based on what percentage of your 401k is rollable. The lenders with this financing will give you 100% of what's in your 401k unless your 401k will prevent that. Sometimes, half of your 401k is still vested with another employer. They only let you use half of the financing as collateral, for example. So the only thing that determines what percentage you can get is what percentage of your 401k is rollable, but you can get an advance up to 100% of what your actual 401k. 2 to 5% interest rate. Awesome. 2-3% interest rate line of credit using your 401k. That's awesome. So imagine how much easier it is to build a business when you have access to a $100,000 2% interest rate line of credit. Pretty cool. No penalties for the rollover. Credit's a non-factor. So 1, 2, 4 of my favorite words in the world. Credit's a non-factor. I love that. Because look, a lot of our clients have credit challenges. It's the way that it is. A lot of our clients have very bad credit, and everybody's turned them away, and banks have told no, and it's ridiculous. But they can still get really low interest rate money just because they have collateral. That's a very important point that I want to mention right here, right now. When you have collateral for business financing, you can typically get very good terms, very low interest rates on a lot of products because you're pledging the collateral even if your credit's trashed. That's what's cool. It's not common in this world to come in and get 2, 3, 4% interest rate credit lines with a bad credit score. With collateral-based business financing, you could do that all day long, every day. And 401k financing is one of the most common ways you can actually get that done. So a little bit more on 401k financing. This is the process. People don't understand it. As a matter of fact, some accountants refute it. They go, you can't use a 401k as collateral. Yes, you absolutely can. Here's the process. You have your corporation. A retirement plan is created for your company. Funds are rolled over from your old plan into your new retirement plan for your current corporation. The new plan purchases stock in your corporation and holds it. Stop right here. Isn't this what a 401k is? All a 401k is you using your money to buy stocks in other companies. That's what a 401k is. With 401k business financing, you're buying stock in your own company. You're not waging your bets on another company to be successful for you to keep your money. You're doing it for yourself. So now you're buying stock in your own company, and then what happens is the company doesn't have any debt, and you're cash rich because now all of a sudden you have access to this massive credit line. So that's exactly how 401k financing works. You roll it over to a 401k that's vested in your own business that buys stock in your company, and then you use that as a collateral or as collateral to get a low interest rate credit line. Also very similar to securities-based lines of credit. The only difference is with these, they use stocks and bonds as collateral. Most stocks and securities are accepted, and you can't get 100%. You can get about 70 to 90%, depending on if it's stocks or bonds or what kinds of stocks or bonds it is. Okay, same kind of rate, 2 to 5%. Working capital line of credit, same. Challenge personal credit's acceptable. Again, it's not credit-driven, so another beautiful thing I like about it. So now you know if you have a 401k or have stocks, or have somebody else that does, you could use as collateral. Why do I say somebody else that does? Because that's one of the most common forms of 401k financing. What happens is you get two people that want to go into business together, or one person that wants to go into another business, and another person that wants to give them financial backing. And yet, a lot of people don't know that those people could use 401ks or stocks as collateral to ingest them and to invest the money into the company. So again, securities-based line of credit using stocks, 401k financing, very, very popular, especially for business startups, because even with challenge credit, you can get low interest rate lines of credit. And what else is cool about this is you can still trade the stocks. You can still trade the stocks. You can still earn all the interest on the stocks. None of that changes, of course, in case of default, and then they'll come take the stocks back. That's, again, what we're talking about today, security-based or secured financing. So another is equipment sale leaseback. So this is using equipment as collateral for financing. Equipment owned free and clear is bought by the bank and leased back to the customer. Now, you can't use equipment you have a lien on because it's already being used as collateral. If you already have money owed against the equipment, you can't use it somewhere else as collateral because it's already used as collateral against the loan that's against it now. So it's got to be free and clear. So you own the equipment free and clear. It's bought by the bank and leased back to you. Equipment sale leaseback. That's what it's called. So you sell the equipment to the lender and you lease it back from them. So if you ever hear an equipment sale leaseback, that's exactly what they're referring to, and that's exactly how it works. So the lender pays the company for the equipment, okay, you, let's say you're the person, they buy the equipment from you for fire sale value, they give you the loan, then that company gives terms to the lease the equipment back from them. So then they let you lease the equipment back from them. That's exactly how an equipment sale leaseback actually works. Okay, now with equipment sale leaseback, $10,000 to $2 million loan amounts, wide range, I know. 12 to 48 months, pretty common. 5 to 21% interest rate, that could be higher. I don't even know why I put 21%. You see equipment financing, equipment sale leaseback sometimes as high as 50, 60% on your money. Equipment's one of those financing is one of those kind of fields that they'll take people with bad credit and they'll charge you a lot of money to do it, but it's not a bad deal. You know, we've seen people that have been able to purchase equipment, not equipment sale leaseback, with horrible credit and save $9,000 a month to their bottom line because they were able to get financing for a piece of equipment that saved them for a fortune. The bottom line thing to know is that it can be expensive if your credit's challenged with equipment, but it's also a great way to go. If you got a good piece of equipment you own free and clear, you could definitely use that, sell it back to the bank, then lease it back from them and get your lump sum of money at a pretty good term. 650 or credit score or higher to qualify. Equipment, it's got to be one piece of equipment worth a lot of money. So think medical equipment, like an MRI machine, okay? Think large presses and other heavy-duty equipment used in factories. I walked into a client's factory. You knew what equipment financing or equipment that would work for business financing was. This guy had, $25,000 to $50,000 machines, and they were all over his building. Any of those he owned free and clear, he could use as collateral. If you think about the medical profession, it's not the printers in doctors' offices that could be used. It's an MRI machine, one big piece of equipment worth a lot of money, not small pieces of equipment. Okay, sometimes I'll mention equipment financing or equipment sale leaseback, and they'll go, hey, man, I got 50 desk printers that I want to combine together, and if I combine them, they're worth $5,000. That's not how this works. They want to see one big piece of equipment worth a lot of money that they can use as collateral. Now, you might say, well, Ty, what does a lot of money mean? Well, what that doesn't, the thing you got to keep in mind is they're going to give you a fire sale value here. So if they're going to give you a fire sale value and cut the value of the equipment in half, well, then that's exactly why you've got to have one big piece of equipment worth a good chunk of money, because they're going to undercut the value substantially and then lend you a percentage of whatever that actual value they come down to is. Inventory loans. Inventory is a common kind of business financing, but at the exact same time, it's also the biggest kind of financing we see people think they can qualify for, but don't. I mean, people try to apply for equipment or inventory financing with some wacky forms of what they believe to be inventory. Okay, and we'll talk a little bit about exactly what kind of inventory they're looking for. But with inventory loans, $150,000 to $500,000 loan amounts. Minimum inventory loan amount is $150,000, and general loan to value is about 50% of the inventory value. So that means the minimum amount of inventory you'd have to qualify would be $300,000. Why? Because the smallest loan amount is $150,000. So you got to have inventory worth about $300,000, and then they'll give you about half of the value of that inventory, about $150,000. And again, this is an auction value, fire sale value they're going to come up with. They're not going to give you the retail value of that inventory. They're going to give you closer to a wholesale value of that actual inventory that they're going to win money on. No lumped together inventory like office equipment. Again, same thing. Think about a huge factory with shelves of inventory. Again, I go back to that same example. A buddy of mine that I helped get it set up for business financing, when you walk in his factory, you know what inventory is. The guy has shelves that are, I don't know how tall they are, 20 foot, 30 foot high in the air, racks of equipment, so high they've got to get big forklifts to get the equipment or to get the inventory down off the top shelves. He's a plastics manufacturer. He makes plastic glasses for like Busch Gardens and stuff like that. You go to Disney, they give you like a mold, like a Mickey Mouse cup. He makes those. So when you go into his factory, he's got just racks and racks and racks of plastic that he uses to mold what his product is. Okay, so think about that. Think about a retail store that has their back section filled with shelves of inventory. If you see a retail store, you're walking around in the front of the store, and in the back of that store, they have shelves and shelves and shelves of inventory. So that's exactly what inventory financing is. Now, they don't want things that, are technology type stuff that can, that can be obsolete in a pretty short period of time. Jewelry, stuff like that doesn't really work for inventory financing. But again, you have big racks of inventory, whether it's whatever it may be for your factory or retail store. Those are people that are actually going to qualify for inventory financing. And rates are normally 2% monthly on the outstanding loan balance. So whatever you have outstanding, 2% monthly is what's charged. Very similar to account receivable financing in the charge. 520 credit score or higher. So again, we follow the same concept here. Security-based financing doesn't require good credit. I mean, it's a big, big lesson to walk out of this webinar with today. If you want the best financing out there, I mean financing that crushes SBA in regards to rates, you need collateral. If you have this kind of collateral, 401ks and stocks and account receivables and inventory, then you can get very low interest rate lines of credit using that collateral, again, even with severe credit challenges, because there's not really a lot of risk. If you default, they're going to come take your inventory, sell it all, get their money back. Okay, so purchase order financing. Letters of credit issued to suppliers or supplier guaranteeing payment. Let me explain to you how this works. Go back to my example, my buddy that owns the plastic manufacturer. So let's say he gets a large order from Busch Gardens. Busch Gardens says, we need 50,000 mugs with our logo on them, plastic mugs. He says, okay. He has to get the plastic from his supplier, and then he has to use that plastic to manufacture the glasses. Well, that plastic for 50,000 glasses could put him out $50,000, let's say. Well, he doesn't want to spend $50,000 to get the plastic, then pay all the money to produce the glasses, then get them to Busch Gardens, then wait 3 months to get paid. You can imagine how that would create a big cash flow issue for him. Well, purchase order financing is amazing. In that exact same scenario, the lender will go to a supplier and go, hey, look, here's a letter of credit. Here's a letter of credit stating that we've got this money put into an escrow account, and as soon as you put those plastic molds on a ship and send it to him and we have confirmation they're on the ship, we release the money to you. So basically what happens is the lender pays for his supplies that he's going to use to manufacture the actual product. And they'll do up to 95% of purchase orders can be advanced. That's pretty good. So then 5% less the fee is released once the actual invoice is paid. Okay, so that works pretty much the same as account receivable financing. So a very good product for somebody that comes in and has a big order or multiple big orders, but they don't have or want to use the money to buy the supplies to fulfill those orders. Purchase order financing works perfect to produce the actual supply or to get the money to get the supplies without them using their own cash flow. $5,000 to $25,000 are common loan amounts on purchase order financing, 1 to 4% interest rate, no credit score requirements, love that to qualify, and cannot be unfinished goods. Goods that have not been completed the manufacturing process. What this means is it means you can't take something in the middle of a manufacturing process and use it. So in that example of my buddy that is producing plastic mugs for Busch Gardens, and he gets the supplier to send him the plastic, well, let's say that plastic wasn't completely created. Let's say the first 2 stages of creating the plastic were done. He couldn't use that then. It has to be a finished good. Once the plastic is finished and it's in the proper form, then it's a finished good. If it was sent to him and it wasn't completed, it was sent to him somewhere in the process, well, then that wouldn't work because it's not complete. It's an unfinished good. So unfinished goods won't work. Only finished goods will work. Commercial real estate. Wow, we get a lot of requests for this. $75,000 to $20 million loan amounts. Now, that is a loan amount range right there. 5% interest rate plus. Owner-occupied investment properties will work. SBA, I left the letter off there. SBA 504 and conventional loans. So what I mean is this. SBA has a 504 program that they'll lend up to 90% of the money you might need to purchase commercial real estate. Okay, you also might just go to a mortgage broker that deals with commercial mortgages and get a conventional commercial real estate loan. Either one are good options. Now, Conventional has much lower loan values. Conventional financing, you could get 55 to 65% loan to value, whereas much different than SBA where you can go up to 90% loan to value. Okay, some more on commercial real estate financing is that your loan to values, again, if you're dealing with conventional financing, you can get 55 to 65% loan to value common, 55% for a cash out refinance, 65% for a purchase. Business must have cash flow to make the payments, and they're looking for about average 650 score or higher. And you've got to have pledged assets required in some cases. So even for SBA, beyond just the commercial real estate itself, you've got to pledge some assets. Now, you have to know this. I have to tell you this. This is tough to get right now. Commercial real estate financing deals are hard to get. And the reason is because commercial real estate runs about 5 years behind residential real estate. So if you think about where we were in 2009 and kind of in the middle or in the tail end of the whole crash in the economy, well, that's where the commercial real estate segment is right now. Because what happens is, people can't pay their bills, and then they lose their homes, and then the next thing they lose is their business. So what happens is usually when residential real estate gets hit hard, about 5 years later, commercial real estate starts getting hit really hard. This was crazy because when I used to own a mortgage company back in the heydays, and things started to really get bad in that sector, it was very interesting because commercial real estate wasn't even affected. They still operated the exact same even though residential was crashing. And then years later, you started to see commercial crash even though residential was making a comeback. So very interesting to know, and it's interesting for you to know because you need to understand that commercial real estate is as difficult to qualify for right now as residential was years ago in the middle of the massive crisis. It's not easy to get, but if you have commercial real estate, you own free and clear, have really little bit owed on it, you can use it as collateral, whether it's for private money, whether it's for SBA, whether it's for a cash out refinance conventional deal. You can definitely use that as another form of secured type of business financing. Now, another type of business financing that a lot of people don't know about that's only applicable to you if you're an insurance agent or have friends or people that might be able to benefit is book of business financing. It's actually specifically for insurance agents. Commissions from the book of business serve as collateral. So what does this mean? Well, insurance agents have what are called renewable commissions. And if you think of it like this, if I have car insurance, okay, now most people on here do have car insurance. When my car insurance expires, I don't know, it's like a 6-month policy, I guess. When it expires, they just automatically renew my policy. I don't do anything. They send me a letter and say, hey, this is not a bill. Here's your new insurance cards. We renewed your policy. Okay, cool. Well, when my policy renews, my insurance agent, State Farm, my agent gets paid. So when my homeowner's insurance renews, he gets paid. When my car insurance renews, he gets paid. That's what exactly renewable commission financing is they have these renewable commissions where people's policies are just renewing and they're getting paid. Well, book of business financing uses that book of business of renewable commissions as collateral for the actual debt. So the program's for insurance agents exclusively, and my example, because my agent State Farm wouldn't work because State Farm agents won't qualify. Now, Allstate, everybody else will. State Farm won't. Why is that? Because State Farm's weird. State Farm, their agents don't actually own their book of business. They word their contracts where they own their book of business, not the agent himself. So because their agents don't actually own the book of business, and since State Farm really does, they're the only agency that won't work. But most other agencies, almost all other, Allstate, all other agents you could think about would work for book of business financing. You could borrow up to 2 to 3 times the annual amount of renewal commissions. That's huge. It really is huge. So only a portion of that would be the actual what they own. So let me give you an example. You might have $3 million in renewable commissions. But if you work with, let's say, Allstate, only 10% of that is actually your money, which means if you ever get out of the business, then Allstate would give you $300,000 for that book of business. That's the percentage that you could use to qualify for the loan, and you can get 2 to 3 times the amount of annual renewable commissions. This is one of these weird products that we see that the people that get these loans usually only get a fraction of what they could get. I mean, they could usually get $200,000, $300,000, $400,000 loans, and in a lot of cases, they don't even want that much money. They only end up securing about $50,000, $100,000. A lot of money can be borrowed in book of business financing. Very popular kind of product that we deal with. Very long loan terms, 3 to 10 years. That's about the equivalent of an SBA loan. 4 to 9% prime rate. That's pretty cool. Actually, I said that about SBA, but what's surprising about SBA is that since so many of their loans are micro loans, their average loan payback is about 6 months, which is crazy because if you think about SBA, you think about long-term loans. But again, according to the Department of Revenue and their statistics on this, that's not the case. Most SBA loans are micro loans, and because those loans are small loans, they're actually short-term loans. But book of business financing is a longer-term loan, 3 to 10 years, equivalent to those longer-term SBA loans. 4 to 9% plus the prime interest rate is what you're going to pay. So that's the money, that's the actual interest rate you're going to pay. Commonly 7 to 11% is the interest that you'll probably end up with, depending on the prime rate. Prime rate, I think, right now floats around 4 or 5%. So anywhere between 7 to 11% is what we usually see rates on this. 650 plus kind of credit scores. Now, another niche industry that has its own kind of financing is floor plan financing for auto vehicles. So if you have an auto dealership, auto vehicles can be used as collateral for financing. It's a revolving line of credit, and then when the car is sold, that piece or equivalent of the line of credit then is collected and paid back. $25,000 to $250,000 loan amounts. And interest rates are typically 9 to 11%. And you got to have a 600 plus type of credit score and strong references. So this is really based on references. I mean, of any kind of business financing program that I deal with or that we deal with, and we deal with most of the legitimate business financing programs out there, this is the one program where strong references are needed more than any other program I've ever seen. So anybody that's a car dealership that's looking for floor plan financing, you've really got to have some strong references. That will, in a lot of cases, determine whether or not you do or don't get approved. Loans under, I actually had this wrong. I said 25 to 250 grand. Actually, you can get loan amounts much higher. The difference is with financials or without. Loans under 250 grand, you don't need financials. You can get approved for even if you have no tax returns, no business financials whatsoever. Whereas financing above 250,000 does require business financials. They're going to look at your tax returns. They're going to look at your P&L statements, those type of things, if you're looking for more than 250 grand. But if you're looking for less than 250 grand, you can secure that. Basically, it's kind of the equivalent of a stated income deal. So now what we're going to do is we've taken a good look at secured financing. We've really looked at what secured financing is. You now know that it's using something as collateral for the debt. You now have learned some very important lessons about secured financing, one of the most being that even people with severely challenged personal credit can qualify for most secured-based financing programs. Not only can they qualify, but as you've learned, they can get ridiculously low interest rates on the financing they secure because they're pledging collateral. The key to success with long-term, low-interest rate financing in the business space is collateral. It's as simple as that. And if you think about it, it's not that much different in the consumer world. A mortgage is 30 years, right? A car loan is like 6, 7, 8 years sometimes now. So long-term loans in the consumer space usually are backed by some kind of collateral. It's no different than in the business space. If you have collateral, that's the key to getting interest there, to getting open-ended credit lines. It's the key to getting long-term loans. It's the key to getting low interest rates, period. Okay, we have a lot of clients that come in and go, I want 5% rate. I do too. You have to have collateral to get it, because even if we run you through SBA, or we run you through a private investor, or we run you through a low interest rate credit line, in most of those cases, they're going to want to see collateral to qualify. So collateral is the key to low interest rates and long terms. It really is. And that's why secured financing works so well for so many people if you have collateral, because even with challenged credit, you can get low interest rates and very, very good terms. But now let's look at the other side of the coin. Let's look at unsecured financing. Because as wonderful and beautiful as secured financing is, from what we see, it's not the most common kind of financing that's out there. The most common kind of financing that we see on a regular basis is unsecured financing. People that do not have any kind of collateral. So with unsecured financing, this is financing that's not secured by any kind of collateral. You don't need to pledge equipment or inventory or 401ks or real estate or any of those type of things to qualify at all. Nothing is pledged as collateral for the debt whatsoever. If the borrower defaults, the lender can pressure the borrower legally, okay, but they cannot just take back a specific piece of collateral. So what that means is it means if you have unsecured financing, and let's say it's with a personal guarantee, well, then that means you personally guarantee in case of default. So if you default on the loan, they're still going to come after you. They're going to sue you. They're going to try to collect on you. They're going to try to garnish your bank account and collect on any and all assets that you have to try to get paid. Okay, but you didn't pledge any one thing as collateral. So you didn't just give them the green light to come in and take any part of your company or your personal assets. They can't just come and say, okay, you defaulted, give us your 401k, because you didn't pledge anything as collateral. But again, that doesn't mean they can't pursue you. Obviously, they can and they will pursue you legally for the money that they think that you owe them or allegedly owe them. Okay, but you didn't pledge anything as collateral that they can just come and take if you didn't pay. So unsecured financing examples from the consumer side include credit cards. It's a perfect example if you think about it. If you go get any kind of credit card, whether it's $300, $400, or $500, whether it's $1,000, $10,000, if it's not a secured credit card, then it's an unsecured credit. Then that means you can come in and you can get that credit card without pledging any kind of collateral. So if you default on a $10,000 Chase credit card, yes, they will maybe pursue you. They're going to try to collect. They're going to try to come after your assets. They're going to try to get a judgment against you. But it doesn't mean that you pledged one thing that they could just come take if you defaulted. Okay, so credit, good personal credit, unsecured credit cards with no personal or with a personal guarantee. So I'm going to show you a couple different main forms of unsecured financing. One of them is based on your personal credit. So this has a personal guarantee, which means you're personally guaranteeing it in case of default. You default, they come after your assets. That's what a personal guarantee means. And they can come after your business and personal assets, just so you know. So the bottom line is, if you have unsecured credit in the business world that's based on your personal credit, then you have a personal guarantee. Now, there is another form which is built with good business credit. If you build good corporate or business credit, you can get unsecured credit cards with no personal guarantee. This is what I really promote. Okay, if you ever see me online, you see I'm a business credit guru. I love business credit. It's the way it should be, because so many people make a mistake right here. They start to build and run a company on their personal credit cards. Then as they use them, their credit scores go down. And if they ever default or go out of business, which, let's be honest, 90% of businesses do fail, then they come after their personal assets. That's no good for anybody. With business credit, once you build your business credit, you can still get unsecured financing based on business credit, but there's no personal guarantee. You're not guaranteeing the money in case of default. So if you default and your business goes under, they can come after your business assets, but they cannot touch your personal assets. The difference is simple. If you have business credit built, you can get money with no personal guarantee. If you don't, you have to get the money with a personal guarantee. Okay, unsecured credit cards with good personal credit. Approval amounts usually 10 to 150 grand. No consumer reporting, some business reporting. So what I mean here is this, and again, this is our most common kind of business financing. Because even though we deal with a lot of people with credit challenges, they have a business partner or somebody else that usually has good credit. So a lot of them go for unsecured financing even when they get other money. Okay, so approval amounts from 10 to 150 grand, no consumer reporting means this credit doesn't report to the consumer credit reporting agencies. It only reports to the business credit reporting agencies. Now, again, this might be a little harder to find. Okay, it's not something you just go find everywhere. If you go to Bank of America and get a credit card, you got to make sure it's a business card that doesn't report to the consumer reporting agencies. And when you do get that kind of credit, it doesn't report to the consumer. It only reports on the business reports. Excellent personal credit with open revolving credit is a must. You've got to have credit. You've got to have open credit right now to qualify, and it's got to be good credit with a few inquiries or less and approval amounts equal to your current limits. Whatever your current credit limits are is what you're typically going to get approved for. And just as you can imagine, since you have no collateral, all that's being used is your credit to qualify. You need really good personal credit to qualify for unsecured credit finance or for unsecured financing. It's based on that credit. 0 to 25% APR, same as normal credit cards. Okay, 0% intro rate for 6 to 18 months, same as normal credit cards. Okay, another kind of financing or credit cards with good business credit. So you can also get your business credit established and get the same kind of loan amounts. They report to the business credit reporting agencies, not the consumer. It takes about 6 months to build your business credit to get to this level, and personal credit's not used for qualification. So if you even have trashed personal credit, you could build a good business credit profile and still use that to qualify for unsecured financing instead of the other one I just showed you. And approval limits, again, are equal to your current credit limit accounts. Same kind of terms, 0 to 25% APR, 0% interest rates, usually for 6 to 18 months. Okay, another kind of unsecured financing is revenue-based financing, where they just look at your revenue to qualify you. They don't look at your actual credit as much. Short-term loans, 6 to 18 months, loan amounts up to $1 million. You can usually get about 12% of your annual revenue advanced to you. High rates, 10 to 45% are the rates, usually higher the first loan you get. 520 credit scores, great for people with bad credit, and good bank statements needed. I show you this because I can show you, hey, unsecured financing with good personal credit or good business credit. What if you have neither? Well, you can still get unsecured financing. How you do it is through a product like revenue financing. Revenue lending, you just basically show 4 months bank statements. They see that you have revenue over $150,000 a year, and they'll give you up to 12% of a loan against of whatever your annual revenue is. So if you make $500,000 a year in revenue, you can get a loan for $50,000. That's unsecured. That's pretty cool. Okay, so another is merchant advances. You've heard about these. Same kind of thing, 6 to 18 months, loans to $1 million, rates at 10 to 45%, 520 credit scores. So very similar to revenue financing. They just use your credit card sales as actual, or use your credit card sales to determine approval, not your actual bank statements. So with that being said, we're going to wrap it up for today. I don't have time for questions. You can email me any questions that you have, although this is a live webinar as I'm doing this right now. I do have another webinar coming up in 4 minutes that I have to get ready to jump into. But if you have any questions, send me an email, ty@creditsuite.com. My first name is spelled T-Y, ty@creditsuite.com, or give me a ring, 877-600-2487. I'll gladly answer any questions you have. I hope you got some real value out of this webinar today. You know the difference now between secured and unsecured financing. You know exactly what could be used as collateral for secured business financing. You know exactly what kinds of unsecured business financing are out there right now. You even have a pretty good idea of the interest rates and terms on all of this financing we talked about. So if you have any other questions, again, if you're interested in building business credit for your customers, obtaining financing for your customers, or just getting business credit or financing for yourself, feel free to give me a call. Feel free to reach out to me with an email. I want to thank everybody very much again for taking the time to attend this webinar. Feel free to reach out to me with any questions that you might have. Thanks again, everybody. Have a great day.